Hey everybody, it's your buddy Dow Jones Dave here with another weekly, well bi-weekly in this case, Industrials Composite Event Report for earnings and dividends. The only event over the last 2 weeks was Merck paid a dividend, and their last boot was a paltry 5.8%. It's not worth mentioning. They have paid out that dividend for 4 quarters, though, so for the next quarter, they're due for a boost of who knows how much, but their last boost was only 5.8%. Now, what I'm going to do is I'm going to start pulling out some premium features on individual stocks when events are slow. Probably not during earnings season. Earnings season, if for a dividend or earnings, you just either get the first one or the second one, just to mark the event. But I'm always into giving you a little tease of what the premium reports look like. By the way, I have all these stats for all of the Dow components, and I update them weekly. First of all, let's look at the Merck does, well, one thing, Merck estimated growth rate is 112.49% on a 52-week PE, last 12 months, last 4 quarters, ending in June, 42.28 PE operating, which means excludes extraordinary one-time non-recurring gains or losses. So, this is a pretty hefty growth rate, but remember what I've said before, estimates are in la-la land. You've got to wait for confirmation. And this growth PE is really good. So Merck is possibly seriously undervalued. However, it's in red because the quarterly year-over-year stats don't look anything like this. So until they do, this is in serious doubt. So that's why it's in red. So as far as Merck is concerned, I'd say mediocre as far as components and under average dividend boost and pretty bad earnings in the latest quarter. So mediocre at best, I would say. If you want to take a risk without waiting for a positive quarter, at least something green, to give this some more merit, then, make your own decision. I'm not interested in Merck, but I reported it anyway. Now, as far as the components, we're in the doldrums between quarters now. This will last for a while. Nike is going to make a report next, I believe, and that'll be the only report for a while. And we may be in the doldrums on dividends, too. Merck paid this out last week, not the week before, actually, here, 7/20, and you can see it didn't really materially affect the dividends much, and no dividend payouts or earnings this week. So all this stuff is pretty much constant now until we get more reporting. The dividend to EPS payout ratio rises when dividends for the quarter are paid out. Earnings are reported first, and those will usually drive the payout ratio down, and then the corresponding dividends are paid out later, and those drive the payout ratio up again, and once dividends are reported, the payout ratio is accurate, because you've got matching quarters, dividends, and earnings. And that still stands pretty far in the red at 50.98%. The Dow, now the barometer went up to 113. Now, if we analyze the barometer and price, we see this is the first week it crossed, I believe. No, it crossed like, I don't remember exactly when it crossed. It was like early August, right at the top, 2 days before the top. Excuse me. Excuse me, I have a cough, and I don't want to pause the video. Okay, so it went up to 111. Week after, it dropped 261.12, which dropped the barometer to 107. Price declines, the barometer comes down. And then it only went up 41.65, and the barometer went up 5 points to 112. Now it dropped 654 and it rose to 113. What this means is that the price change isn't having much of an effect on the barometer. In fact, the pressures against the market, regardless of the drop in price, are even stronger than they were last week. And that makes me still short of opinion. On cash right now, I got a 22-point rally scare me out of my short positions Friday. And I don't want to talk about that much, but that makes me a new money short. So what do I think here? I think we need to when to enter. Are we overextended to the downside? Well, we just broke through a head and shoulders formation. And that's pretty short. Okay, plus all this stuff is indicating a short, plus earnings estimates here. These are the estimate revisions for the composite, which are derived from the average of all of the data I have for each of the 30 stocks, and then converted into the Dow scale, and this is what you end up with. On the premium version, you get the actual estimates. This is the regular free version. At least you'll get to see what the trend is. So, technicals. We see A, B, and C, an ABC correction. And one thing about Elliott Wave is I don't take too much from Elliott Wave, but this is one of the things I do, and I give it a high confidence rating. And I'll show you why. I have another chart set up for the first time I ever used this calculation. Interestingly enough, I didn't believe the result when I did the calculation, but I'll show you an very interesting chart. Had to go back more than 20 years to get the period, because that's when I did it, and I wanted to just go through my psychology as I did this calculation for the first time on the NASDAQ. So anyway, we have A plus B. This is A, B, and C, 2688 from the top of the B wave is 32,380. So when you get within spitting distance, a percentage or two of this number is when you would start rotating to the long side, because this is only an approximate target. I mean, it gets pretty darn close, but it's not exact. And you'll see what I mean in a minute. So, does this C wave level correspond to resistance? Yes, it does. I also think we might end up down here. Not sure. Depends on a lot. So anyway, that's the technical situation. Head and shoulders pop. I call it a trend break. You can call it whatever you want. So what I like to see is a gap down and then up here a retest and then come down, or a gap up tomorrow to this line, in which case it'll qualify as a short-term retest. And the momentum is straight down. All the MACDs are down, but they crossed a bit ago, so it's a medium mature rally. It's not old yet, but it's not new. Rally decline. I'm sorry. I think rally because I'm in puts and they go up when it goes down. I'm sorry. I think backwards sometimes. So anyway, you want to see a rally here, retest. That would be great on an open. Gap up here, and then down we would go. So why do I put a lot of confidence in this? Oh, by the way, here's something that can help you make Elliott Wave easier. See this box here? When you see something like that in Elliott Wave, you can just get rid of it, and it makes your count more clear. A, B, C. See that? Thought you might find that interesting. So trading ranges, you just condense them. So this would be 1, 2, 3, actually be 1, 2, 3, 4, 5, A, B, C. Now I know my ABCs. At kindergarten I could do this. I like this because you can do this formula on a piece of paper with a pencil faster than you can do it with a spreadsheet. So anyway, why do I put a lot of confidence in this? Well, let's take a look here. This is the internet bubble. And I was present in the markets for this. And believe it or not, I saw it coming because in December, I think it was, inflation started to tick up. And I started telling all my investor friends, I think maybe you better be ready to sell stocks in a little bit. And sure enough, it ticked up. Bonds, it ticked up, and the market didn't like it, and down she went. So, this is the first time I ever did this calculation, and just for shits and grins, I said, well, let's do that ABC calculation and see where Elliott wave ABC correction theory puts the bottom. So we calculate the A wave, which is 2090. We calculate the B wave from here, which was 1,247. And I did this calculation like somewhere around here. And it was between 36 and 4,000 when it was clear that, yeah, this is going down. So 2,090 plus 1,247 equals 3,337. The B wave top is 4289. Minus 3337 equals 962. And in my head, from up here at 4,000, I said, no way, it's not going down that far. No, I don't believe that. And I kind of discounted that calculation, but I remembered it. And as I remembered, it was more like 1,200. But I did the calculation here, and it says 962, so who knows? But if you notice, it went down to 1054.89, within 1% of 962, the target. And that's why I have a lot of confidence in the ABC pattern and the ABC corrective calculation. Because, look at that. And that was calculated up here. I mean, this is taking it from 4,200 down to 1,000, 75%. And it was pretty darn accurate within 1% of the final bottom. And it was a little liberal. So that's why I said, when it gets within 1 or 2% of that target, maybe you want to just get out and start going long because the target might be a little bit low. So at any rate, that's why I have a lot of confidence in this formula. Now, the last thing I have going here is yield curve. It came down on this end and went up on this end. So the yields are moving towards repair of this whatever you want to call it, this thing that I've never seen anything like ever in 30 years of tracking investment and in another 30 or 40 years of back researching the market and looking at these things in the history. Nothing ever like this have I seen. So when it looks like this thing's starting to move towards repair, which would put these down here and these up here. A healthy yield curve goes like this. All right? And a normal inversion would go like this. Going down a little bit like somebody stepped on it. Not like a fucking army trampled over it. So this is pretty brutal here. It's a heavy short indicator. Because this can't last. It's impossible. So anyway, yeah, that's my report. And I hope you enjoyed this part of it. Because I was pretty surprised. I'm like, holy shit. It actually worked. And so that's why I put a lot of confidence in that. And I do that. The way you identify a B wave is did a trend break